Next, we move to Unit 3, Acquisition of Business. What do you mean by an acquisition? An acquisition is when one company purchase most or all of another company's share to gain control of that company. Purchasing more than 50% of a target firm stock and other asset allows the acquirer to make decisions about the newly acquired asset without the approval of the company's shareholders. Acquisition, which are very common in business, may occur with the target company's approval or in spite of its disapproval. With approval, there is often a no-shop clause during the process. Then we see the types of acquisition. First one, friendly acquisition. Second one, reverse acquisition. Third one, back flip acquisition. Fourth one, hostile acquisition. First we'll see what is friendly acquisition. Both the companies approve the acquisition under friendly terms. Example, Johnson & Johnson medical companies is Crucial Biotechnology. Then we go for the reverse acquisition. A private company takes over a public company. Example, Clear Wireless Broadband to take the Sjctnc. Then third one, back flip acquisition. The purchasing company becomes a subsidiary of the purchased company. Example, Texas Air Composites with Continental Airlines. Then fourth one, hostile acquisition. Here the entire process is done by force. Example, Oracle with PeopleSoft. Then we go for acquisition, why and why not. Why it is important? What are the problem with acquisition? First we will see why it is important. It increased market share, it increased diversification, excessive competition and cost maximization. Then problem with acquisition, inadequate valuation of target, inability to achieve synergy, finance by taking huge debt. Then we see the factors associated with acquisition of business. Some important factors associated with acquisition of business are explained as follows. First we see the factor purchase. The company which acquires or purchases the business of other is known as purchaser. Vendor. The organization which sells its business is known as vendor. Purchase consideration. Purchase price paid by the acquiring company is called purchase consideration. The purchase price or purchase consideration will be discharged in the form of shares or debentures or cash. Then we will see the determination of purchase consideration. Generally, the purchase price is determined at the time of negotiation and shown in the agreement itself. This means it will be given in the question itself. If it is not given in the question, the method of determining the purchase consideration are given in the following. Method 1, net asset method. Under this method, the purchase consideration is ascertained by adding up the asset taken over by the purchasing company minus the total amount of liabilities taken over. We see the formula, purchase consideration equal to aggregate value of asset taken over minus aggregate value of liability taken. At this juncture, one has to understand and distinguish between the types of asset taken over by the purchasing company and the type of asset not taken over by the purchasing company. Asset to be taken over by the purchasing company. In the absence of a contract, to the contrary, the purchasing company take over the following asset: land and building, furniture and fixtures, machinery and plant, stock in trade, book debts, otherwise called as debtors, cash and bank balance. The following assets are not taken over by the purchasing company: all fixtures asset, all prepaid expenses, profit and loss account debit balance, miscellaneous expenses such as discount on shares or debentures, underwriting commission, etc. Similarly, only the external liabilities of the selling concern are taken by the purchasing company, but the internal liabilities of the selling concern such as share capital, reserve fund and undistributed profit are not to be taken by the purchasing company. Then we go for the second method, net payment method. Under this method, purchase consideration is determined according to the terms and condition of purchase agreement, that is, which asset to be taken over and at what value, which liability to be taken over. Purchase consideration equal to asset to be taken over at agreed value minus liabilities to be taken over at agreed value. Important note, if the value of the net asset is less than the purchase price agreed to be paid, then the difference is treated as goodwill and that amount has to be debited to goodwill account, credit, exit, debit. For determining capital reserve or goodwill, balance sheet figures of the selling concern, that is vendor, should not be taken into account, but it should be only on the figures at which the company acquired in its books. Then we'll see the difference between net payment method and net asset method. In the net payment method, all the payment made to the shareholders of the transferor company by the transferring company are added to calculate the purchase consideration. The net asset method or adjusted net asset method is a business valuation procedure which is used in acquisition accounting. It changes the stated values of a company's assets and liabilities in order to reflect its current fair market values. Under the net asset method, the value of various assets are added and deducted from the values of various liabilities to calculate the purchase consideration. The value of the asset and liabilities are agreed upon by the purchasing company and the vendor company. They are not the values of these assets and liabilities which are entered in the vendor company's balance sheet. Then we will see the various entries in the books of vendor company when new set of books is opened. First one, for asset taken over by a purchasing company. Realization account data to sundry assets. Then we go for the second one, for liabilities taken over by the purchasing company. Liabilities account data to realization account. Then for purchase consideration, the journal entry will be purchasing company account data to realization account. Then for realization expenses paid by the vendor company, the entry will be realization account data to bank account. For receipt of purchase consideration, bank account data, shares in new company account data, debentures in new company account data to purchasing company. Then in the books of purchasing company, the following journal entries will take place. For purchase of business, business purchase account data to vendor company. Then for asset and liabilities taken over by purchase company, asset taken over account data to liability taken over account to business purchase account. Note, if the credit exceeds the debit, the difference should be debited to goodwill account. If the debit exceeds the credit, the difference should be credited to capital reserve account. Then third entry, for payment to vendor, vendor account data to cash or bank account, to share capital account, to securities premium account, to debentures account. Then for interest due, interest account data to vendor account. If it is interest is paid, then the entry will be vendor account data to bank account. When debtors and creditors taken over on behalf of the debtors, often a company does not take over the debtors and creditors belonging to the vendor, but merely agrees to collect the debt and pay the creditors on behalf of the vendor. This means that any profit or loss made in the processes will belong to the vendor. First we will see the vendor suspense account. In the process of collection of book debt and payment to creditors, if any loss and expenses and gains such as bad debt, discount, etc. arises, such profit or loss will have to be borne by the vendor. In this case, purchasing company open a vendor suspense account in its books. Then we will see the debtor suspense account. A debtor suspense account arises when a company takes over the debtor of another company. The difference between the amount due and the amount released will be transferred to suspense account. Then we will see the creditor suspense account. A creditor suspense account arises when a company takes over the creditor of another company. The difference between the amount to be paid and the amount paid will be transferred to suspense account. We will see the journal entries in the books of purchasing company when debtors and creditors taken over on behalf of vendors. First one, for the acquisition of debtors and creditors on behalf of vendor. Vendor debtors account data to vendor's creditors account to vendor suspense account. For realization of amount of debtors, bank account data to vendor's debtors account. Then third one, for loss on account of bad debts and discount allowed to debtors, vendor suspense account data to vendor debtors account. Then fourth one, for payment made to creditors, vendor creditors account data to bank account. Then fifth one, for gain on account of discount received from creditors, vendor creditors account data to vendor suspense account. Then next one, when irrecoverable bad debts are recovered, bank account data to vendor suspense account. Then for commission due to purchasing company, vendor suspense account data to commission account. For final payment to settle the vendor's debtor and creditors, vendor suspense account data to bank account, to share capital account, to debentures account. Next we will see the journal entries in the books of vendor. For closing debtors balances, purchasing company suspense account data to debtors account. For closing provision for doubtful debts, provision for doubtful debts account data to purchasing company suspense account. For closing creditors balance, creditors account data to purchasing company suspense account. For bad debts, discount allowed, payment of any omitted liabilities, commission due to purchasing company or any other loss. Then the entry will be profit loss adjustment account data to purchasing company suspense account. Then next entry for discount received, recovery of bad debts, written off or any other gain. Purchasing company suspense account data to profit and loss adjustment account. For distributing the net gain in the profit and loss adjustment account, the entry will be profit and loss adjustment account data to partners capital account to capital account. Then for amount received from purchasing company on account of collection of book debt less payment to creditors, bank account data to purchasing company suspense account. Then the next entry for distributing cash among the partners or owner, partners capital account data to bank account. Then second model, when same set of books are continued. Sometime on conversion of a business into a limited company, no new set of books is opened, but the books of the old business are continued. When the purchasing company decide to continue with the same set of books, then the following steps may be taken. First one, revaluation of asset and liabilities. A revaluation account should be opened where increased and decreased value of asset and liabilities are to be adjusted as is done in case of admission of a partner. The profit and loss on revaluation should be credited to partners capital account in their old profit sharing ratio. Then second one, closing of asset and liabilities not taken over by the purchasing company. Any asset or liabilities which is not taken over by the purchasing company should be transferred to capital account in profit sharing ratio. But when an asset is worth its book value, the same can be transferred to capital account according to the ratio of final claim. Then third one, distribution of reserves and losses. Any balance of accumulated or undistributed profit or reserve should be transferred to capital account in profit sharing ratio. Then fourth one, closing the capital account. After making the above adjustment, the capital account are closed by debiting the capital account and crediting the shares or debentures or cash. Then we go for the preparation of revised balance sheet. At this stage, a revised balance sheet can be prepared. The next one, debtors and creditors are taken over when same set of books are continued. The following accounting treatment should be carefully followed if the debtors and creditors are not taken over by the company and the same set of books are continued. Debtors and creditors should not be closed. Two separate accounts for debtors and creditors should be opened under the head debtors suspense account and creditors suspense account. Then it should be remembered that the capital account of the vendors have already been credited for debtors which appeared in the balance sheet. As the new company is not taking over the debtors, vendor capital account must be reduced by the like amount without, however, cancelling the account of debtors. Needless to mention that the same is done with the help of debtors suspense account by the following entry. Vendors account data to debtors suspense account. In the same way, vendor account should be credited in the light of creditors account. For this, the following journal is passed. Creditors suspense account data to vendor account. For collection of cash from debtors, cash account data with the amount of cash received, discount allowed account data with the amount of discount allowed to debtors account with the same amount of total debtors. One more entry is to be passed. Debtor suspense account data for cancellation of credit to vendors account, fresh credit to vendors for the amount collected on its behalf, to discount allowed account for cancellation of debit in the discount allowed account. Then we will go for the next transaction for payment to creditors. Creditors account data with the amount of total creditors, to cash account with the amount of cash paid, to discount received account with the amount of discount received. One more entry is to be passed. Vendors account data, fresh debit to vendor for the amount paid on their behalf, discount received account data for cancellation of credit in the discount received account, to creditor suspense account for cancellation of debit. Now the net amount collected is paid to vendors. The entry will be vendors account data to cash account.